Well, probably a lot of you are aware of the fact that a couple of years ago, China exceeded the U.S. in the size of their auto market, and our auto market is around 17 million cars here in the U.S., new cars, and they are up to 25 million, so it's not even close anymore. Yeah, it's big things happening there. All right, so welcome everybody to our first, we've kind of gone into a pattern here of doing two of these a year, one in January, we'll kick off the new year, and one in June after a lot of our data come out in the annual CSCMP's logistics report. And there's certainly, at least from my perspective, it's a really interesting time. It's a new year because it feels to me, after looking at this data, like it's different. So I'm anxious to share some of this with you. As I've done in the past, if you've attended, I'll talk about the ISM's Purchasing Managers Report, both local and national. Talk a little bit about inventory and then the energy markets. So if you're not familiar with the ISM report, the magic number is 50. Above 50 means things are growing, things are that's a positive sign, considered to be a positive sign. Under 50 is retraction. So as we look at these numbers, that's what to look at. All right, so Buffalo Area PMI, the last period we have data for is November. It's at 62.1, compares similarly to what we saw most of 2017. The strongest areas most recently are production and employment. Here, this is again the local area. So what's happened in 2017 is we've seen a strong year. It's not an accelerating trend during the year, but it's continued strong. And compared to the national ISM is at 59.7, so we're similar to that. Our economics professor, Dr. Randy Cragen, is the person who does this locally. We appreciate his work on this. All right, I pulled this up. This is the national, so this is not local. This is national numbers. They have very strong validity. And the things I've highlighted, things I want to talk about. So the average is around 60, which is very positive. Remember, 50 is, anything above 50 is good. The 60s is historically excellent. These are some of the strongest numbers we've seen since 2006. And the strongest areas are production and new orders. So that's a very positive thing for going forward. The weakest numbers, all right, so let me explain this to you with inventories. Under this structure, numbers above 50 mean that companies are building inventory in anticipation of good things in the future. So it's an investment in inventory, basically. All right? So numbers under 50 mean that inventory is contracting. Now that, in this particular instance, I would interpret that as an unintentional thing, that businesses, well, they are managing inventory better. It means probably the inventory in the last few months have been drawn faster than they anticipated. And that this is actually a very positive sign, because at some point those inventories are going to need to be rebuilt. Right? But so that's why I put it in red there. I think that should draw special attention to people. And then the highest number, well, almost the highest number on the whole page here, prices. Prices are accelerating. I think this is going to be a theme of the morning. All right, let's move on a little more specifically with inventory. And this is the inventory to sales ratio that, if you've been at the forums before, we always report on this. And when we started doing these in 2015, we were very concerned about this right here. Right? Higher, this graph going up is a bad thing. That means inventory is building in relation to sales. So what we saw in the Great Recession is you had sales falling, inventories accumulating, and then took about a year to readjust to that. We were really concerned about this time period, 2014, 2015. Was it a recession? What was it exactly? We're still not certain. Last year was better. Now this year, and especially in the last few months, we really start to see this drop off. This is a really good thing. Means inventories are being managed better. Sales in relation inventories are more positive. So this is very positive. And this is pre-Christmas season. This is pre-tax cut news. So I would expect to see this fall off even more over the next couple of reports. By the way, this ratio will be put out by the federal government tomorrow. So our timing is just a little bit off. We could have gotten the update. So just a little more detail about that, because behind that chart is a lot of specific data and different categories of inventories that are always interesting for me to look at and try to parse out what's driving these changes. So department store inventories were down 5% year over year. Now we're seeing the contraction in brick and mortar stores. As these stores close, obviously inventories are decreasing. But I'm also reading that just some companies like Target, for instance, have figured out how to live in the e-commerce world and are just doing a better job of managing. So it's not inevitable that every brick and mortar store is gonna fail or accumulate excessive inventories. So there's a lot of that. And again, the Christmas sales, which from everything we've read are quite strong, are not in this report yet. So it'll be really interesting to watch this over the next couple months. I've been watching auto inventories for the last couple of years, and actually it's kind of an area of concern. Inventories had crept up the last few years, and a lot of very long loan repayment time periods and other things which look like they would depress future sales. But the auto companies have done a better job in 2017 of bringing down those inventories. GM in particular, at the end of the year, has 68-day supply of cars versus 104 in August. So they worked pretty hard to bring that number down. It's pretty important in my view. Auto sales have probably peaked last year, 2017. They were down a bit. It's a really important part of our economy. Okay, quick energy market update. And anybody recognize this ship here? This is the Sanxi, currently burning off the coast of China near Shanghai. It was involved in a collision over the weekend and is continuing to burn. Apparently yesterday there was a section of it that exploded. They're concerned about it actually exploding and sinking because it's got a lot of oil on it. And the best thing to happen would just be for it to sit out there and burn it all off, but we'll see what happens. Let me just give you a little perspective while this picture's up here. This ship holds 1 million barrels of oil. Okay, so you hear these numbers, and you'll see some of these numbers in the future slide. This is 1 million barrels of oil. The world's production and consumption is very close now to 100 million barrels a day. So this represents approximately 1% of the world's daily oil production and consumption. Right? So it's not a big deal that one ship, goes down like this, but it gives you some scale of how much oil we're continuing to use. By the way, some other interesting facts about this ship. So this is an Iranian ship. Owned by the Iranian shipping company, registered in Hong Kong, moving Iranian oil to South Korea, and was involved in an accident off of Shanghai. And I didn't know this, maybe Tempao knew this. So this area of the East China Sea is known as the New Bermuda Triangle. And in 2016, 33 ships were lost in this area of the East China Sea. So, there's thousands and thousands and thousands of ships out there, and losses continue to be significant. Most of them are to be smaller ships, but it's an interesting little factoid. All right, energy markets are on the way up. And so we see over the last 2 years kind of a steady rise of the energy markets. And I did not predict that oil would be this high this quickly. Those of you who've been coming regularly know I've been saying for the last couple of years we're in this range of $40 to $70, and it was going to be hard to get out of that range. We're not out of that range yet, although we're getting close. In fact, this was in December. This morning, Brent is about $70, and West Texas Intermediate is at 64. So we continue to rise. Part of the reason is inventories, and I'll show you that in a minute. The numbers are here. I've got the chart coming up for oil, but let's point out natural gas. Natural gas inventories, this line here, which were at historic highs a couple years ago, are coming down. Right? But demand for natural gas continues to go up. Supply of natural gas continues to increase. It's in my view, it's a great fuel and will continue to be a very strong fuel, even as oil, I think, will decline. Drilling in the U.S. is up. Production in the U.S. is up. Natural gas prices have not really reflected that at this point. Right, this was a year ago, okay? And if you've been following these markets, the line to look at here is the blue line. These were unprecedentedly high levels of inventory in oil and refined products in the United States. Right? Just accumulating, above the 5-year average, above any historical number, above the 5-year range. All right? So that was a year ago. This is now. Right? That blue line, which is inventory levels in 2017, right to the end of the year, are falling, and they have now fallen, getting close to the 5-year average. So we're into a normal range, and we're into a normal market, basically. It's not by any means shortage or it's going to trigger price spikes, but it's a normal market again. I've always put this slide in here because people who are new to these presentations, what the oil market's all about, I won't spend a lot of time on it. But again, we're close to 100 million barrels a day, demand and supply. Saudi Arabia, Russia, and the United States are the 3 big players in production. And I just want to make a note about our production. Has gone from about 6 million barrels up to 9 million barrels due to fracking. This year will be 10 million barrels a day. But the upside is we can't go from 10 to 15 million barrels now. We might go to 11, we might go to 12. And we can talk about this at the question and answer if we want to, but the Saudis and OPEC are much more disciplined this year than they have in the last couple of years. And they can take 1 million or 2 million barrels out of the market just like that. The U.S. cannot put 2 million more barrels into the market overnight. It would take us a year or two to do that. All right, so leads us to my insight on this. And OPEC has realized that their strategy of trying to push the frackers out by lowballing the market with price, that's what they were trying to do a couple years ago, did not work. So they have backed off that strategy. They've reduced supply, and other OPEC members have agreed to do that too. Right. As I mentioned, U.S. production can go up some, but especially if we have the growth that we've seen this year in global markets, we're going to have upward pressure on prices. People are talking about short-run issues in Iran. We know what's happening in Iran. The worst case scenario there is like a Syria type of civil war where it's really bad, and that would probably pretty much take out most of the oil production. A best case scenario is that the Islamic regime is taken out peacefully, and you can have a lot of Western investment come in there, in which case would cause a considerable increase in oil production there. The Korea wild card is a big one. Some kind of a nuclear event there would cause certainly a spike in oil prices. Venezuela, which is a large oil producer in decline. Again, to me, there's more upside there than downside. If the government there was to lose power, and again, you could have Western investment return, you could have a big increase in Venezuelan oil production. All right, that being said, so in the short run, I would say that the price pressure on oil is upwards. But long term, oil is a fuel of the past. I really believe that we'll be saying that in another 5 or 10 years, and I didn't always feel that way. I mean, I've been very tried to be a realist on the oil markets and contrarian a lot of times. If you heard the phrase peak oil 5 or 10 years ago, it was like, oh, we can't produce any more oil. We've hit our max. Now the phrase peak oil is referring to global demand, because especially the transportation sector is going to be moving pretty quickly to electric. And also what remains of internal combustion engines are becoming more and more efficient. Ride sharing is going to save a lot of energy. The whole idea of the Uber and the Lyft, people like us are not necessarily going to have 2 or 3 cars in the future. It's just not going to make economic sense to do that. China is aggressively going after electric cars. They recently banned a bunch of models that were fuel inefficient and heavy polluters. And green energy, which is improving. Its cost basis is improving. It is more competitive with traditional fuels. And oil will always have a place, but it's long term. I just don't, people who say, oh, oil might go to $100 or $200 a barrel, that they were talking about a few years ago, I would find that unlikely. So, final slide here, my predictions, and I always go back, unlike many economists and business people who don't want you to look at their predictions, at least whether they're right or wrong, we'll go back and look at them. So I've been predicting rising from a bottom that was about a year or so ago, and I had predicted for June 15, 2017 that we'd be at 40, we were actually at 45. I had predicted for last month that we would be at 50, we were actually at 57 on December 15th. I had predicted in June, the last time we were here in June, this is the comment I would made that prices would go up, but it would be hard to get above $60 a barrel. I think what's changed is the strength of the global economy, which not too many people saw. The strength of the American economy is strong. The recession, we've had how many years of economic growth, although slow, and rather than going into maybe a recessionary cycle, as some people predicted, it almost seems like that's an acceleration of our growth cycle at this point. So I'm predicting for a year from now that we'll be about where we are now with oil, that may go up and then come back down. But that'll be strong. I think it's going to be really hard, in my view, to push oil above $70 to $80 to $90. There's just a lot of new oil that'll come on the market. There'll be some demand destruction there. And so that's my prediction. And I think everything that I have discussed here today would say that we're going to see inflation. Oil prices going up, growth going up, inventory levels are under control. That's the perspective I have right now. So thank you.